Hello traders, how's it going? In today's video, we'll be going over phases of price delivery, swing formation, and daily bias. These are the foundational concepts on how to frame narrative, and my goal in this video is to simplify them and make you understand them with ease. But before we go right into the teachings, I would like to give credit to the MMXM trader, T-Trade, Garrett, known as GST, and as you all know, we can't talk about these three mentors without mentioning ICT, because they all trade his concepts. So shout out to these great mentors, because I've learned a whole lot from them, and all what I'm going to teach you in this video is a piece of what they all teach. I highly recommend you go check them out. So we will take a look at the PDF and then we'll go through a couple of examples to solidify this concept. Starting with phases of price delivery. When we are talking about phases of price delivery, we are indirectly talking about market structure. A market structure defines how price move within different phases. And there are generally 4 phases of price delivery, starting with expansion, retracement, consolidation, and reversal. But before we dive into understanding each of these phases, let's first of all look at the rules that govern the market algorithm and how it flows with these phases. What can price do and not do? Price always goes from a consolidation to an expansion. Price can go from an expansion to a retracement. Price can go from an expansion to a reversal. Price can go from an expansion to consolidation. Price never goes from a consolidation to a reversal. Price never goes from a consolidation to a retracement. Every phase starts and ends with expansion. Looking at it on this flow chart, expansion into retracement leads to expansion. Expansion into consolidation leads to expansion. Expansion met with expansion will lead to a reversal. Price can never go from a consolidation to retracement, and price can never go from a consolidation to reversal. So if you are following up closely, you must have noticed that consolidation and retracement are just continuation signatures. Why? Because we know that if price expand and retrace, it must expand again. If price expand and consolidate, it must expand again. So what that means is consolidation and retracement are just continuation signatures, because we know for sure if we get an expansion followed by a retracement, what phase we are going to get next is an expansion. So if we get an expansion followed by a consolidation, the phase we are expecting next is expansion. So now that we know the rules and how the market flow in respect of these phases, let's dive and have a deeper understanding on how they actually print on the charts and their signatures. Starting with expansion signatures. On the left here we have the higher time frame expansion candle, and on the right we have internal lower time frame expansion. But what is an expansion candle? An expansion candle is any candle with a small wick size and a large body. That is what separates an expansion candle from a reversal candle, which we are going to get into in a minute. So assuming this to be a daily candle and this right here an hourly or 30-minute PA. So on our way to a draw on liquidity, what are the internal lower time frame expansion signatures we want to see? We want to see opposing candles supporting price towards ERL. We want to see lows being rejected, highs displaced through. We want to see shallow retracement. What that means is we want to see opposing candles or other blocks supporting price towards our draw on liquidity. We want to see short-term lows being rejected and short-term highs being displaced through. We want to see shallow retracement. We do not want to see deep retracement into discount of any expansion leg. And as you all know, if price expand and retrace it, it must expand again. So these are the signatures we want to see inside of this higher time frame expansion candle. So moving on. Let's take a look at the continuation signatures. As we learned in the previous slides, there are 2 types of continuation signatures. We have the consolidation and the retracement. Starting with the consolidation. What is a consolidation? This is generally when the market trade into an objective but fail to reverse and start moving sideways within a defined range, indicating a lack of clear trend direction. And what is a retracement? This is generally when the market trade into an objective and start pulling back, leaving behind failure swings. These failure swings will later on act as draw on liquidity when the market expands again. We know that if the market expands consolidate, it must expand again. And we also know that if the market expands, retraces, it must expand again. So knowing this, how can you participate in the next phase of expansion? How can you trade the consolidation and how can you trade the retracement? Let's dive into it and see how we can actually participate in the market. Starting with consolidation. There are generally two types of consolidation. We have the consolidation where the market expands away without manipulating the opposite side of the range. And we have a consolidation where the market manipulates the opposite side of the range before expanding. This right here is the AMD consolidation. Now let's look at how we can trade this consolidation where the market expands without manipulating the opposite side of the range. First, the only way we can trust that this consolidation has ended is when the market failed to manipulate this high by breaking outside of the range. Now we wait for a continuation signature to form. It can either be a small consolidation outside of the range or a retracement back inside the range, which will form a down close candles in a series or a single down close candle back inside the range. And we can look to take a trade once we close above the series of down close candle, or in this case, a single down close candle. We can take a trade from here, placing our stop loss below the nearest swing low or below the consolidation range. So how can we trade the AMD consolidation? Because we know this is the ideal scenario where we have the accumulation, manipulation, and then distribution. We first of all wait for the manipulation leg to form, and we wait for price to close above the series of down close candles that form the manipulation leg. Once this happens, you take a trade, placing your stop loss below the nearest swing low, or you can place your stop loss below the accumulation range low, targeting your objective. Now let's take a look at how the consolidation look on the higher time frame. Here we have price traded into this key level, in this scenario the fair value gap, but failed to expand away from it. We instead form an inside bar candle followed by a manipulation, then accompanied by expansion candle. So we have accumulation, manipulation, then expansion. And note that we only trade the expansion candle. We do not trade the manipulation candle and we do not trade the accumulation candle. We only trade expansion candle. So moving on to our next continuation phase, which is retracement. As we learned in the previous slides, retracement is when the market trade happens when the market trade into an objective but fail to reverse. Rather, it start pulling back, leaving behind failure swings. These failure swings will later act as draw on liquidity in the next expansion phase. So how can we trade this retracement? We know that as price is retracing, it will either retrace back into an imbalance or a fair value gap. Once it retraces, it will put in a short-term low. We need to wait for price to manipulate the short-term low, close above the series of down close candles that form the manipulation leg. Then we can trust the market to enter a trade, placing our stop loss below the recent swing low, targeting the retracement high or a much further objective. Now, how can we trade from external range back into internal range liquidity? Or how can we trade the retracement back inside the range? We need to seek manipulation. We need to wait for price to manipulate the recent swing high that it formed and close below the series of up close candles that formed the manipulation leg. Once this happens, you can trust to enter a trade, placing your stop loss above the recent swing high, targeting the internal range liquidity. And this is how the retracement is going to look like on the higher time frame, where you have expansion into an objective followed by a pullback or a retracement. In this example, we have a single candle retrace back into this fair value gap followed by a reversal candle. This reversal candle represents the manipulation leg. So you need to wait for this reversal candle to close and then you trade the expansion candle that follow after that. And here we are on our last phase of price delivery, which is reversal. What is reversal? This is generally when price trade into a key level and immediately expand away from it, forming a V shape where we have expansion met with expansion. So this is how it's going to look like on the higher time frame, where we have candle 1 trade perhaps into a key level and candle 2 fail to display below candle 1's low, so closing back inside the range of candle 1. How can we confirm this reversal? we can confirm a reversal with an XMT. We need an XMT divergence between two correlated assets, where one asset trade into a key level and the other asset failed to reach that level. Once this happens, you can wait for a close above the series of down close candle that form the manipulation leg. That will form a CSD, which is a change in state of delivery. You can look to take a trade targeting the opposite side of the range. So we have another example here where price trade into a key level and immediately expand away from it. So after we have a CSD, which is candle closing below the series of up close candle that form the manipulation leg, you can trust to take a trade targeting the opposite side of the range. Let's take a look at swing formation and daily bias. What is a swing point? A swing point is generally a 3-candle pattern where candle 1 and candle 3 fail to take candle 2's low if in a bullish scenario. But if in a bearish scenario, we have candle 1 and candle 3 will not take the high of candle 2. And there are generally two types of swing formation. We have the C2 close swing formation and we have the C3 close swing formation. C2 just stands for candle 2 and C3 just stands for candle 3. Let's start with the C2 close or the candle 2 close swing formation. How does it form? It always starts with candle 1, right? Candle 1 will trade or expand. Then candle 2, as we know candle 2 to be a reversal candle, it will fail to display below candle 1's low, closing back inside the range. Once this happens, you can confidently anticipate candle 3 taking the high of candle 2, reaching out for candle 1's high. So we are anticipating candle 1 to expand. This will help you a lot in determining your daily bias as well, because once you have the reversal candle, you know that the next candle will be an expansion candle in the opposite direction, right? So, and here, as we can see, is developing. We have candle 1, candle 2 reverses, and candle 3 expands, displaying above candle 2's high, reaching for candle 1's high. And as you see, it develops to candle 4. As candle 3 display above candle 1's high, this permits candle 4 to display above candle 3's high, also reaching for candle 1's high. And if this happens, you can also anticipate candle 5 to display above candle 4's high. But you need to know that after 3 consecutive candles, the market will generally go into a new phase of price. It can be a retracement or a consolidation. So let's take a look at the difference between this swing formation here and this one. As you can notice here, we have candle 2 did not display back within the range of candle 1's low here in this C3 close swing formation. But candle 3 display below the low of candle 2's low. So this, once we have candle 3 close below candle 2's low, you can anticipate candle 4 expanding or displaying below candle 3's low, reaching for candle 1's low. As we can see, it developed here completely, where we have candle 4 displays below candle 3's low, reaching for candle 1's low. So these are the two types of swing formation. And this will help you a lot in determining your daily bias, because once you have candle 3 display below candle 2's low, you can confidently anticipate candle 4 displaying below candle 3, reaching for candle 1's low. Putting all what we have learned together, we can see that it developed into a market maker model. In this example, a market maker buy model. So we'll start from the higher time frame. As we can see, price expanded into an objective, created a key level, which is a fair value gap, retraces back into that key level, form a reversal candle, which is a C2, followed by 3 consecutive expansion candles, which is the distribution phase, right? So we have the retracement, the SMR, which is smart money reversal, followed by distribution. So let's look at it on the lower time frame. We start with the reversal. We have price expanded into a key level, then expands away from it. So we have expansion met with expansion. This is a reversal signature. And how do we confirm a reversal signature? We need to confirm with an XMT. So here we got an SMT. And once we got the series of down close candle, once price close above the series of down close candle, we can be confident to say that price is going to expand in the opposite direction. So after the expansion leg, we got a retracement, which is a continuation signature. So after the retracement, we close above the series of down close candle that form the retracement leg, which is our low risk buy. We have another displacement followed by a small consolidation, which we know that consolidation is a continuation signature. Once we manipulate the consolidation leg, we get another phase of expansion followed by a retracement, which is a second stage distribution. After the retracement, we got another expansion followed by consolidation, then completing our market maker buy model with a silver bullet. So once again, we have the smart money reversal, which is expansion made with expansion followed by an SMT confirming the reversal. We have a change in state of delivery, a candle closing above the series of down close candle that formed the manipulation leg. We have the retracement, which is a continuation signature. Once we close above the series of down close candle that formed the retracement leg, we then have another phase of expansion, displacement creating the fair value gap, followed by a small consolidation. We manipulate the consolidation low, starting the first stage distribution. We expand away, followed by retracement. We close. After the retracement, we expand again, starting the second stage distribution. Then finally completing our market maker buy model. So let's go through some example right now to finalize our teaching. All right, let's take a look at some examples here. Here on the left, we have ES, and on the right, we have NQ, and we are currently on the weekly time frame. Let's look at what the previous week did, because for us to be able to determine the bias of this current week, we need to check the previous week's data, right? So previous week, as we can see, we have a key level here. The previous week traded into this key level, right? We had a swing point here. We took out that swing point with this last week candle. And where is the same level on NQ? This is the same level. We can clearly see that we did not reach this level on NQ. So we formed an XMT here between these two correlated assets, because if ES traded into this level, NQ should also trade into this level. But since it failed to do that, we formed an SMT divergence. And what else can we notice? We can notice a reversal candle that formed right here, right? So put that red. So we traded into the key level and formed a reversal candle. So with this in mind, we can clearly say that we are expecting a bullish candle going in for this current week, which means we are going to reach for this buy side liquidity going this week. So we are expecting a bullish candle, a up and low, high close candle. So with this in mind, let's drop down to the lower time frame. And I'll be honest with you guys, I just bought this account with TradeZella, and I created this session. I've already fast forwarded or traded the Tuesday data, though I didn't take a trade on Monday, but I'm facing some issues here whereby I cannot see the Monday candle on the daily time frame. But if I drop down to the 4-hour candle, the Monday data is visible. As you can see, we have Monday, then we have Tuesday. But on the daily time frame, I cannot see the Monday candle. I don't know why that's happening here. So we are going to review the Tuesday's candle, because this is the candle that I traded. I took a trade there, and I want us to review that as an example here based on what we have learned throughout this video. So we need to review last week's candle. How did the last week candle, weekly candle formed? We opened on Monday, traded into this swing point, then closed back within the range of Friday candle, forming a reversal candle. What do we know about reversal candle? We know that if a reversal candle formed at the key level, then the next candle should trade or should expand in the opposite direction. So having this reversal candle formed on Monday, we already automatically know that Tuesday up till Friday is going to be expansion days in the opposite direction, right? So, and we can see that playing out here. Though on Tuesday we didn't expand that much, it was just kind of like a consolidation candle. But on Wednesday we did expand drastically. Then on Thursday we retraced it back in the range. Then Friday we expand again. So if we retrace this back in the range on Thursday, creating a fair value gap, what do we see here? We see another reversal candle that has formed on Thursday. That means Friday was supposed to trade back into this fair value gap here, right? Because we have a reversal candle here. So just to put this in line, this reversal candle holds more strength when it forms at a relevant key level. That is when it's going to be highly effective. But if it forms at a level that is not relevant or not at a key level, then you're just going to consider the higher time frame that the candle are just a retracement candle, and that is the case we had here. We can see that Friday did not pull back into this imbalance here. Since it failed to pull back into this fair value gap and displays through the high of Thursday's candle, we can confidently anticipate Monday or Tuesday to expand. So why are we anticipating a bullish candle going into Monday and Tuesday? We anticipating a bullish candle because we know that Friday displays through the high of Thursday where we had a key level. It didn't trade back into it. We could still have this scenario where Monday pulled back into this fair value gap before Tuesday now manipulate to expand. But since that was not the case here, we are only getting a continuation off of this order block. So we have this order block as our price, as our key level where the low of the week formed from, right? So we had Monday trade into this level. Just we can't see the data of Monday here, but we have access to that of Tuesday. So Tuesday traded into this order block, taking out the low of Monday, then expands away. So let's drop down the lower time frame to see how this plays out. Here we are on the lower time frame, and we know that in the future market, indices market, it opened at 1800, right? Unlike Forex that opened at 1700. So we'll mark at our 1800 candle. And before we continue here, let me go back to clear out something. We know that if we are expecting a bullish candle on the weekly time frame, what should it do first? It should open, put in a low before expanding. The same thing if we are expecting a bullish candle on the daily time frame, then we expect that daily candle to open, put in a low first at the key level, then expand away. So as we drop on the lower time frame, we are just looking to identify the key level where we expect the low of the current day to form from, right? We expect the current day to expand away from. So here we are on the 4-hour time frame, marking out 1800 candle, which is right here. So if I mark out this 1800 candle, what are the key levels? Oh, blindly say we didn't have that PA yet, right? So what are the key levels can we identify off of this that we think the day should reverse from? We have a swing point here, right? We have a swing point. Sorry guys for this because I cannot go back. This is back testing, so it's not like TradingView where I can just cut off some PA to show you something clearly, but we'll just manage with this one. So we have this swing point as a key level where we can anticipate the low of the day to form away from, and we also have this fair value gap. So we expect the day to open, trade into this one of this key level, then expand away from it, and that is exactly what happened. We can see that the day opened at 1800, traded into this imbalance, then reverse away from it, right? And we had after the 1800 candle, we had the 2200, which was just a consolidation because it never went out of the range of the 1800 candle. And as the 2200 candle consolidated, the 2 a.m. candle manipulates. It manipulated the low of the 2200 candle. Let me zoom in. You can see clearly here, right? It manipulated that low, then expands away. So we know that if we get manipulation, we need an XMT, right? If we get a manipulation off of a key level, because now this 1800 candles low is a relevant level, right? Because on the lower time frame, like on the hourly or 30-minute, it's going to be a swing point, and we can see that here. It is a swing point, so it is a relevant level. So if we manipulate a relevant level, what do we need also at that level in order to trust that price is going to reverse away from it? We need an SMT, right? You can clearly see that on ES, we took the low of the 1800 candle, but on NQ, we did not take out that low. So we had an SMT here. So this is clearly showing that you could still trade the 2 a.m. candle because why? It traded down into a key level, manipulated it, formed an SMT, then trade away from it. So let's take a look at it, how we could even trade this 2 a.m. candle. So marking that out, we have the, let me just mark it out so we can, do I have it? Yeah, this is the 2 a.m. candle. So we can drop down to the lower time frame to see if we get another swing point, or we get a swing point accompanied by the SMT in order to trade away from this key level, right? So we have and the same thing, before we continue, the same thing as we expect the daily candle to open, trade into a key level before expanding away. That's the same thing we expect the 4-hour candle to do. We expect the 2 a.m. candle to open, trade into a key level, then expand away from it. And we can see that here on this weaker assets. We can see that on ES, that the 4-hour candle, what did it do? It opened, traded into a key level, which is the 1800 candles low, then expand away from it. That's exactly what we want to see. So going back to the hourly time frame, we have the hourly time frame here. On the hourly time frame, what are we looking for? We are looking for a reversal candle to trade away from, because we only want to trade expansion. We do not want to trade reversal candle. We want to align ourselves with expansion, right? So we drop down on the lower time frame. What are we looking for? We are looking for a reversal candle to trade away from. So here we are on the hourly time frame. Do we have any reversal candle to trade away from? Yes, we do have a reversal candle. From where? From the key level that is being accompanied by an SMT, right? So we have here this reversal candle. Let me mark that out for you. We have this reversal candle here. And also on NQ, we formed a reversal candle. So we have this reversal candle formed at 2 a.m. The 2 a.m. candle is a reversal candle, and we can trade the 3 a.m. going through 4 to 5 a.m. candle, closing out the 4-hour candle. So since we have a reversal at 2 a.m., we can drop now down to the 5-minute. That's our time frame alignment, right? From daily, 4-hour, 1 hour to the 5-minute for entry. So we drop down now on the lower time frame, on our entry time frame, execution time frame, which is the 5-minute. Which candle are we trading? We are trading the 3 a.m. candle, right? Which is the expansion candle. We are aligning ourselves with expansion. That is what we want to do. But before we align ourselves with expansion, we need to look on the lower time frame. As the reversal signature, we know, which is expansion made with expansion from a key level, which can be confirmed with an SMT, right? We have a key level already, and we have the XMT. So we need just a reversal signature now to confirm that price is going to pull away from this level. So we are now on the lower time frame. What can we see? We can see that price expanded into this level and just did what? Form equal lows. It did not manipulate. This is when we actually manipulate, forming the XMT, presenting the SMT, and this manipulation occurred at 2 a.m. So the 2 a.m. candle close at this point. The 3 a.m. candle open and retraces after we have already confirmed our reversal with expansion into a key level, then expansion away from it. So we have our change in the state of delivery. We have a CSD here. Let me mark that out for you. So you can immediately take a trade once this retracement leg has been broken. That means when price close above the series O, in this example, this down close candle that formed the retracement leg, then you can take a trade targeting this high or a much further target you might have in mind, whatever you can see on the chart, right? So what do we have? We have a key level, SMT, a reversal signature, a retracement. And what do we know about retracement? Retracement is a continuation signature. So once we get these 3 criteria met, price expand. Once he retrace, we are just waiting for price to close above the series or the single down close candle that formed the manipulation, the retracement leg. Once we get the closure above it, then we can execute targeting your external range liquidity or internal range liquidity, depending on the model where you are trading. So this is just one example, just to show you how you could actually trade that 2 a.m. candle. I hope this finalized the video and help you understand this concept a bit more. And I really wanted to do more of these examples, but the video has been too long. So I'm certainly going to bring forward part 2, perhaps here. There's going to be part 2 of this teaching. So, and thank you so much for watching the video up to this level. I hope you have learned something here. If you have, please just give me a follow and why not a like. See you in the next one.